Hello all, welcome to Paritranaya. In this class, we shall discuss about another very important economics related topic, that is balance of payment. So very important both from exam point of view as well as a general curiosity. Because as a citizen of this country, we need to know about the balance of payment of this country. So this indicates how much we owe to the external entities. So here, what is balance of payment? It is the difference between all money flowing into a country in a particular time period and the outflow of the money to the rest of the world. So what does it mean? Now, India, so to India there will be incoming money as well as outgoing money. In what format the money will come and in what format money will go, we shall not worry about it. But we know that to India, money will come from what? Outside world, from other countries. Similarly, from India, money will go to other countries as well. So this is inflow and this is outflow. So balance of payment is the difference between inflow and outflow. So balance of payment is the difference between inflow and outflow. So this is very important. So we need to understand whether this balance is positive or negative. We need to understand whether this balance is positive or negative. So always the incoming money should be what? More, and outgoing money should be incoming money should be more and outgoing money should be less. Okay, incoming should be more and outgoing should be less. Okay, less. So if incoming money is more and outgoing money is less, then we call it as surplus. If incoming money is more and outgoing money is less, then we call it as surplus. But if incoming money is less and outgoing money is more, then we call it as deficit. Okay, deficit. So what is this deficit? Deficit is more outgo, less incoming. And what is the surplus? Surplus is less outgo and more incoming. Okay? More incoming money. So we are interested to know whether it is surplus or deficit with respect to various different entities. Okay, so that gives a picture about India's trade balance. Now let us look into the components. So when I say incoming money, when I say money is incoming, money is outgoing. Now when money is coming into India, we are classifying it into two different categories. So one money, the type of money which will come, one type of money we call it as, it will go into current account, and another type of money which comes into India, it goes into capital account. So why we have segregated it into current account and capital account? Just for the convenience of maintaining these records. Okay, otherwise it is beyond the scope of our discussion. We shall not go beyond it. So we shall assume here that there are two types of accounts. One is current account and another one is capital account. So when the money is incoming or when the money is outgoing, either it will come into current account or it will come into capital account, or it will go out from current account or go out from capital account. So next we will be discussing in detail what kind of money will come into current account and what kind of money will come into capital account. But for time being, we shall assume that the incoming money can go either into current account or capital account. Okay. Similarly, the outgoing money can go out of the current account or it can go out of capital account. Okay. So as an example, I have taken here, India sells a pen to foreign country. So India, it sells a pen to foreign country. So let us assume it sells a pen to USA. India sells a pen to USA. So when India sells a pen to USA, whether India will earn money or it will lose money? Obviously it will earn money, especially it will earn dollars. So when India sells money, so USA will give India money. It will be dollars. Okay, dollars. So when this money comes to India, where it will go? Whether it will go into current account or capital account. So it will go into current account. It will go into current account. Okay, current account. Now similarly, if India sells, or we shall take another example. If a person from USA buys Indian company, let us assume there is a company called as Company A in India. There is a company called as Company A in India. A person from USA will come and he will purchase this Company A. He will purchase this Company A. So when he is purchasing Company A, whether India is earning or money is going out of India. Obviously, money is coming into India, especially he will come with dollars. So dollars are coming to India. So money is coming to India. But when this money is coming to India, we will not take this money into current account, but rather we will take this money into capital account. Okay. Why we will take it into capital account? Because here, if you look at the asset, the company will last for a very longer time. So it's a capital asset. So whenever someone is investing in a capital asset, how we consider it under the capital account. Similarly here, when he purchases the company, it will come under capital account. Okay, it will come under capital account. Next, similarly, outgoing money. We shall just reverse this scenario. So here we have taken this, India sells a pen to foreign country. Similarly, if India buys a pen from foreign country, if India buys a pen from Japan, what happens? Will India earn money or it will lose money? Obviously, it will lose money. Okay, money will go out of India. So when money is going out of India, from which account it will go? It will go out of current account. It will go out of current account. Similarly, when an Indian purchases a company in Japan, so in order to purchase that company in Japan, so Indian money has to flow out from India and it has to go to Japan. So when this money goes out, from which account it goes? It goes from capital account. It goes from capital account. Capital account. Now, another important point to remember here is when it comes to balance of payment, we are not confining our discussion, or it is not confined only to government entities. So when I say someone from USA purchases in India, so it not necessarily USA government or Indian government entity. So here government as well as private sector is involved. So when I say a person, India sells a pen to foreign country. So when I say India, so in India it may be government or it may be private sector. Similarly, when I say USA person comes and buys Indian company A, so it may be a USA government or USA's private person or any civil citizen. Similarly, when I say company A, need not necessarily be government company. It may be a government company or a private company. It means when I speak about balance of payment, I am speaking about the government plus private sector together. Okay, together. So here, this is about what money flowing in and money flowing out. So flowing into current account and capital account, flowing out of current account and capital account. Okay, flowing out of current account and capital account. So this is called as balance of payment. Okay, balance of payment. Now next, we shall go specifically into the different accounts, that is current account and capital account. So first we shall go through what? Current account. Okay. So balance of payment, current account and capital account. Within current account, we have merchandise, data related to merchandise trade and data related to invisibles. Similarly, within capital account, we have data related to foreign investment, next loans, banking capital and rupee debt service. From exam point of view, what kind of questions they may ask? They may ask you like, so merchandise is part of capital account. If they make such kind of statement, that will be false. Similarly, they may say, so loans is part of current account. That will also be false. So we need to understand that merchandise and invisibles, they are part of current account. Foreign investment, loans, banking capital and rupee debt service, they are part of capital account. They are part of capital account. Now next, when you look at, we need to understand these various things. What is merchandise? What are invisibles and all? Now, okay. So current account consists of merchandise. Anything which is visible and if trade occurs with respect to that item, we call it as merchandise trade. We call it as merchandise trade. So here, now India, let us assume it buys a what? Computer from USA. It buys a what? Laptop from China. Next, it buys a pen from Japan. Next, it sells some wheat to Japan. It sells some what? Jowar or other grains to what? USA. It sells some bread to China. So this is a trade which is happening between India and the external world. So in order to make our discussions easier, rather than focusing on all the countries, I have just taken 3 external countries. One is external entities, USA, China and Japan. So here we are seeing the trade that is happening. So between India and China, we sell wheat and we buy pen. Here we sell laptop and we buy bread. Here we sell jawar and we buy computer. So all these items, whether it is jawar, whether it is computer or laptop or pen or wheat, all of them, they are visible to our eyes. So whenever the trade happens in such kind of entities, we call it as merchandise trade. We call it as merchandise trade. So export and import of goods. Okay, export and import of goods. Next, whether merchandise trade overall it is positive or negative. So what is positive or negative? As I mentioned, whenever we earn more money and lose less money, then we call it as what? Positive. Okay, we call it as positive. So it means when there is more export, let us assume of 1,000 rupees. There is a export worth 1,000 rupees and import worth 800 rupees. So when we export, earn more. Okay. So here import, so lose money, lose less money. Okay, lose less money. So here we have what? 200. This is surplus. Okay, this is surplus. Export more and import less. But the reverse, import is more of 800 and export is less, let us assume of 600. And here it is 200 deficit. Okay, deficit. So in this context, when it comes to merchandise trade, India is what? Merchandise trade overall deficit or net negative. It means we import more goods and we export less goods. Okay, we import more goods and export less goods. So this is also equally important. Okay, equally important. So first kind of questions they may focus is whether merchandise is part of the current account or capital account. So it is part of the current account. Next, merchandise is whether net positive or net negative. It is net negative. Why it is net negative? Because we import more items and we export less items. Okay, we earn less and we spend more. Okay, while trading with the other countries. Earn more money. Next, invisibles. Now, whenever we do trade on the things which are not visible to us, so such kind of trade, they come under invisibles. So let us take an example. Now, a person from USA visits India. So let us call this person as person 1. Now, from India's perspective, forget about USA's perspective, from India's perspective, for India, whether this constitutes import or export. So this is a very important point to note. So from India's perspective, it is export. Why it is export? Because when a person from USA comes to India, he spends in India, for example, for staying in a hotel and for using what? Travel services. For using travel services and all. So when he's spending on hotel and spending in what? Travel services, so he is using the money which he has brought from USA. It means India, it's like earning for India. Okay, it's like earning for India. So it constitutes an export. So when a foreigner comes to India, it becomes what? Export services for India. Similarly, when Indian person goes to China, let us assume person 2. So he'll take India's money and he'll spend in China for staying in a hotel and for traveling in a bus, car, etc. So now this will become what? Import for India. Why it will become import? Because we are losing money. Okay, we are losing money. So such kind of services which are not visible. Now whatever the services he has enjoyed, so it is not visible. So such things we call them as invisibles. Okay, invisibles. So the first thing that we need to remember here is it is net positive. It is net positive. So what is that net positive? When it comes to invisibles, we earn more and lose less. Okay, lose less. So with the help of an example, if we want to remember, then we can imagine that more number of people visit to India for tourism and lesser number of people from India go to other country for tourism related things. Okay, in this fashion we can remember it easily. So here net invisibles is positive, whereas net merchandise is negative. Okay, so important points to note. Here, in order to confuse us, they may frame a statement like this. So net invisibles in India, it is what? Negative. Net merchandise in India, it is positive. So in this kind of mismatches they can do. So that's why we should have this what crystal clear idea that when it comes to invisibles, it is net positive, and when it comes to merchandise, it is net negative. When it comes to merchandise, it is deficit. When it comes to invisibles, it is surplus. It is surplus. So here in services, I just took one example of what? Travel and transportation. Similarly, there are many services. It may be insurance, software, communication services, etc. So software service. So software which is not visible, but the software services can be exported to other countries, and similarly we'll be importing from other countries. Okay. So software services. So this was about one component of what? Invisibles. Okay. Services. Now within invisibles, we saw example of a service. So when it comes to services, it is net positive. It is net positive. Because apart from services, we have two more components. One is transfer, another one is income. So total invisibles is net positive. Within invisibles, services is also net positive. Okay, net positive. Next, transfer is also net positive. Net positive. Whereas income is net negative. Okay. So within invisibles, two are net positive and one is net negative. Next, we shall understand what are transfers. What are transfers? Now when it comes to transfers, so there are official transfers and there are private transfers. So first we shall understand this. Now let us assume USA has sent some money to India, to Indian government. USA government has sent some money to Indian government. Let us assume in India to handle some situations like flood and all. So all of it is sending some relief, okay, in the form of money. So when this money is being sent to India from USA government to Indian government, it will come under official transfer. It will come under official transfer. Similarly, if Indian government gives some money to Japanese government for some purpose, so then this also comes under official transfer. So official transfer can be from other country to India. At the same time, it can be from India to other countries. Next, private. Private means when, let us assume, a person from India is working in Japan. So every month when he gets salary, so he'll be sending some part of the salary back home to India. So this we call it as remittances. 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 Okay. So these remittances are part of private transfers. Private transfers. So here we took an example of a person of India who is working in China. Similarly, a person of Japan may be working in India and every month he will be sending back money to Japan. Remittances. So again they fall under private transfers. So private transfers can be both way, from India to other countries as well as from other countries to India. So if you look at the net value here also it is positive. Okay, transfers is also positive, services is also positive. Now next, coming to income. Now an Indian company invests in USA, or an Indian, he invests in a USA company. Okay, USA company. So let us assume he will invest after 1 year. USA will send returns. That is, either it may be profit or interest. It will send it back to the investor. Okay, investor from India. So now the returns, whatever the India is getting, so these are called as investment income. Investment income. So an Indian person has invested in USA company. So after getting profit, USA company, after at the end of every financial year, it will be sending back the dividends or interest. So that will be part of what? Investment income. So investment income. Similarly, a person from China will be investing in India. So at the end of the year, when the profits come, so that dividends or interest will be shared with the investor who is present in China. Okay, who is present in China. So again that comes under what? Investment income. Again, coming to investment income, it can go from India to other countries, and from other countries also it will come to India. Okay, India. Similarly, compensation of employees. Now, a person working in India from Japan, a Japanese person is working in India, he will face some problem. So because of that problem, Indian company will give him compensation. Similarly, some other person may be working in Japan, so he will face some problem there, so he will get compensation. Okay, compensation. So again, this compensation can go from India to other countries, or it may come from other countries to India. So both way. If you look at the income, it is net negative. So what does it mean? So as an example, in order to remember this easily, what we can take is, so the people coming from other countries. Okay, so people coming, for example, people coming from other countries, they send more remittances. They send more remittances than people residing in India. Okay, then people residing in other country sending back the remittances. In that fashion, you can remember. So here, when it comes to income, it is net negative. Income is net negative, transfer is net positive, services is net positive. Next, capital account. So here, when it comes to capital account majorly deals with what? Investments and loans. So here we come across a component called as foreign investment. So here within this foreign investment, it can be foreign direct investment or foreign portfolio investment. So we have discussed in detail about the difference between foreign direct investment and foreign portfolio investment in a separate video. So you can watch that video in order to get insight into it. So here at the superficial level, we shall understand that foreign direct investment is something where a foreigner comes and invests in a country. For example, a USA person will come and he will either start a company or purchase an existing Indian company. So that will be considered as FDI. Okay, FDI from USA into India. Similarly, if a person from India, if he starts a company in Japan or buys a company in Japan, then that will be considered as what? Indian FDI in Japan. India's FDI in Japan. Now this is about FDI. Next, portfolio investment. So in portfolio, a person from China, he will come and he will not purchase the company, but rather he will purchase the shares. Okay, he will buy shares. So here they bought a company, buy company. In FDI, they will either buy company, but here in foreign portfolio investment, they will not buy the company, but they'll purchase few shares. Okay, so this at a superficial level understanding would be sufficient. So that is portfolio investment. So here we come up with a term called FII. This indicates foreign institutional investor. Foreign institutional investor. So here, as I mentioned, when they are purchasing, when a Chinese person, China purchases shares from Indian company, so an individual will not be able to purchase it. So a company in China, so it can purchase the shares from India. Okay, shares from India. So when a company is purchasing, we call it as an institution. So foreign institutional investor can invest in portfolio. Okay, can purchase shares. We have already seen about the securities and the different types of securities. One is equity, the other one is what? Bond. So equity market and debt market we have seen. So when it comes to foreign direct investment, it will happen in equities. Whereas when it comes to portfolio investment, it can happen in both equities as well as in debt. Okay, in debt. So these things we have discussed in detail in the other video. Here at the superficial level, we shall understand that foreign direct investment and foreign portfolio investment. So these are part of capital account. Here, if you look at foreign direct investment, it is net positive. Again, very important. It means the people from other country investing in India is more compared to Indians investing in other countries. So foreign direct investment is net positive for India. So similarly here, net positive or negative is not important for portfolio investment. So just ignore it. Next, apart from the foreign investment, we also have another component, loans. So here in loans, what happens? So a foreign entity. So in case of external assistance, for example, some other country, USA government or someone will give loan to India. Next, our World Bank will give loan to India. So this will be what? External assistance. For example, World Bank. Okay, World Bank. Now, commercial borrowings. So when it comes to assistance, the rate of interest will be less. Whereas when it comes to commercial borrowings, the rate of interest will be bit high. Okay, bit high. Next, short term to India means whenever we borrow a loan for a period which is less than 1 year, then that will be considered as short term. Okay, short term. Here they'll not focus on detailed aspects of all these things. At the superficial level, we need to understand that external assistance and commercial borrowings, so all these, whether they form part of current account or capital account, they form part of capital account. That would be sufficient. Okay, and they are part of the loans. Similarly, banking capital. So a person from USA or China, he may open a bank account in India and he may deposit some amount. Similarly, a person from India, he may open a bank account in Japan and he may deposit some amount. So these are called as what? Banking capitals. Okay, especially commercial banks. So rupee debt service indicates, so whatever the loan which the India has taken, okay, whatever the loan that India has taken, and for that every year debt service means we have to pay the interest. Okay, so regarding that it is rupee debt service. So not an important component. Okay, not an important component. Here the important components are foreign investment, that is FDI, portfolio investment, and loans. Okay, loans. So this topic is important from both prelims as well as mains point of view. So predominantly from prelims, and in mains, wherever possible, if we are able to quote about the statistics related to balance of payment, then definitely it will fetch us what? Good marks. Okay, so here in this class we discussed about balance of payment, and within balance of payment we saw that there are two different types of accounts. One is current account and the another one is capital account. Within current account we have merchandise and services, invisibles, and within invisibles we saw about services and income and transfers. And when it comes to capital account, we broadly saw that it consists of foreign investment, loans, banking capital, and rupee debt service. So this was about balance of payment. Similarly, in the forthcoming classes, we'll be discussing about the other important topics related to economics. For all our further updates, subscribe to our channel and hit on the bell icon. Thank you.